Imagine cutting through pages of, financial jargon and dense numbers to instantly get what truly matters in a bank report.
Yeah, getting straight to the point.
Exactly. That's our mission today. We're taking a deep dive into the latest unaudited financial results for Utkarsh Small Finance Bank Ltd. This is for the quarter ended June 30, 2025.
And these results, they're fresh off the press, just approved by their board. They offer a really fascinating glimpse into how a bank is navigating some pretty significant strategic shifts.
In what's definitely a dynamic market, right?
Absolutely. It's always changing.
So for this deep dive, we're pulling our insights straight from the source, their investor presentation, the official press release, and the outcome of their recent board meeting.
We want to unpack the key highlights, really understand the underlying trends.
And pinpoint the strategic decisions that are shaping Utkarsh Bank's journey right now. By the end of this, you should walk away with a much clearer picture of the performance and, well, what it might mean for their future.
Sounds good. Let's jump in.
Okay, so let's start with the big picture. Q1 FY26 overview. What's the snapshot look like?
Well, looking at the overall picture, the gross loan portfolio grew, but pretty modestly, just 2.3% year over year. It hit about 19,224 crore.
Okay, modest on the loan side. What about deposits?
Deposits showed much stronger growth, up 18.3% year over year, reaching 21,489 crore.
That's quite a jump.
It is. And what's really notable there is the retail term deposits, or RTDs. They grew a robust 33.7% year over year. That's a big driver.
So strong deposit gathering, especially retail term. And remind us about their scale.
They're significant, operating through 1,099 branches across 27 states and union territories. So quite a wide reach.
Okay, wide reach, strong deposit growth. But then there's the headline shift, isn't there? The profitability.
Yes, that's the kicker this quarter. A net loss of 239 crore in Q1 FY26.
Wow. And that compares to what last year?
A net profit of 137 crore in Q1 FY25. So a really stark contrast.
That's a huge swing. What about the pre-provisioning profit?
That also took a big hit. Pre-provisioning operating profit, PPOP, it basically shows core operating health before loan loss provisions. That dropped substantially too. It came in at just 92 crore this quarter, down from 311 crore a year ago.
Over a 70% drop. So what's the management saying about this? This can't just be brushed aside.
No, definitely not. Govind Singh, the MD and CEO, he commented that this quarter saw a, quote, continued strategic pivot towards secured lending amidst a difficult operating environment.
Okay, so linking it to that strategic shift.
Exactly. He specifically mentioned taking a prudent stance on new sourcing in the unsecured microbanking segment due to recent stress indicators.
So pulling back deliberately on unsecured microloans because of rising stress?
Precisely. He acknowledged that this measured approach, well, it definitely impacted short-term interest income, no surprise there.
Right.
But he framed it as aligning with their long-term asset quality goals. So short-term pain for potential long-term gain.
That makes sense. Taking the medicine now, hoping for better health later. Okay, let's dive deeper into that loan portfolio then, because that's where this strategic pivot really plays out.
Absolutely. You can really see the shift in the mix.
So what are the key numbers there?
Well, the non-JLG portfolio, that's non-joint liability group loans, showed really strong momentum. It grew significantly, up 39.4% year over year, hitting 10,646 crore.
Nearly 40% growth in non-JLG.
Okay.
And the JLG side, that's the traditional microfinance group lending.
Right. And conversely, that portfolio contracted by 23.1% year over year, down to 8,578 crore.
Wow, a 23% contraction. So that's the deliberate pullback in action.
Exactly. It's a very clear, conscious move to reduce exposure to those unsecured microbanking loans, de-risking the book.
And how does that change the overall composition, the secured versus unsecured mix?
It shifted quite a bit. The share of secured loans within the total loan book has now risen to 45% as of June 30th, 2025.
Up from
35% just a year ago, June 2024. So a 10 percentage point shift towards secured in just 1 year.
That really underscores this focused effort on de-risking and improving asset quality, as you said.
Definitely. And they're not just shifting the mix, they're also trying to optimize yields within those secured products they're focusing on.
How so?
Well, they've been actively working on yields. Disbursement yields on housing and MSME loans, for instance, increased by about 40 to 150 basis points compared to Q1 last year.
So getting slightly better returns on the new secured loans they're booking. Okay, let's break down the specific loan segments. Microbanking first.
Sure. So in microbanking lending, as we mentioned, the JLG disbursements slowed down. They cited tightened guardrail norms,
Stricter lending rules, basically.
yeah, stricter internal rules,
Yeah.
plus those concerns over collection efficiency we talk about. So instead of pushing new loans hard, they focused efforts on collections
Makes sense.
and also on increasing customer connect. Interestingly, they opened savings accounts for over 65% of their microbanking customers, trying to deepen that relationship.
That's a smart move, potentially building stickiness and maybe improving financial discipline down the line. What about other microbanking products?
Their microbanking business loans, MBL, seem to be scaling up okay. They saw a 29% year-over-year growth in that loan book.
Okay. Now, what about the other retail lending, the MSME, housing, CE, and CV stuff?
Right. Those segments are generally seeing more consistent growth. MSME, specifically the retail assets part, showed an 11% YoY disbursement growth.
And is that mostly secured?
Oh, yeah. Over 95% of that MSME lending is secured. It fits right into their strategy.
And housing and the vehicle equipment loans?
They're also contributing significantly. Average disbursement yields were pretty decent too, 11.1% for housing and 12.8% for CE and CV in this quarter.
Got it. And there's also wholesale lending.
Yes, that's about 11% of the total gross loan portfolio. It includes small to medium-sized corporates and their business banking group.
And the risk profile there.
Looks quite solid, actually.
Yeah.
The entire book is secured against immovable properties. And impressively, over 70% of that book is rated A category or higher by external credit rating agencies.
So that provides a nice anchor of stability within the overall loan book.
Exactly. A lower risk segment balancing out some of the challenges elsewhere.
Okay, let's switch gears to deposits and funding. A strong foundation here is obviously critical, especially when profitability is under pressure.
Absolutely crucial. And as we touched on earlier, total deposits surged, up that impressive 18.3% year over year to over 21,400 crore.
That really highlights their ability to pull in funds.
It really does. And the retail term deposits, the RTDs, were a huge driver, up again 33.7% YoY to nearly 11,700 crore.
What about CASA, the current and savings accounts?
Also strong growth there. CASA deposits grew 22.5% YoY to over 4,200 crore.
So good growth across both term and CASA on the retail side. How does that affect their CASA ratio?
It improved slightly. The CASA ratio moved up to 19.7% as of June 30th, 2025, compared to 19.0% a year earlier, moving in the right direction.
And the credit to deposit ratio. That's another key balance sheet metric.
Also improved. The CD ratio came down to 83.4% this quarter, down from 92.7% a year ago. If you exclude refinance, it's even lower, around 76%. So a much better balance between loans and deposits now.
That's a significant improvement. Less reliance on wholesale funding, presumably.
Definitely. If you look at their funding mix evolution, deposits now make up 66% of their funding. That's way up from, well, actually, it's a shift away from refinance compared to their MFI days. Back in March 2020, deposits were much lower, refinance was dominant. Now refinance makes up 29%, and other borrowings are just 5%.
Okay, so a clear strategic shift towards more stable deposit funding. That's positive. What about where these deposits are coming from? You mentioned their branch network is widespread.
Yeah, this is interesting. While the bank has a strong rural and semi-urban presence through its microbanking history, the demographic profile of their deposits, excluding the ones sourced digitally, is actually heavily weighted towards metro and urban areas.
Really? What are the numbers?
About 52% from metropolitan areas and 41% from urban areas.
So over 90% from metro and urban centers. That's fascinating. They're essentially gathering funds from cities to lend, at least historically, more in semi-urban and rural areas.
It does highlight that kind of structural dynamic you often see with small finance banks,
Yeah.
relying on wealthier urban deposit bases to fund lending in traditionally underserved areas.
Okay, that brings us inevitably to asset quality. We've hinted at the stress. Let's look at the numbers.
Right. This is where the impact of that microbanking stress becomes really clear. There's been a very significant increase in non-performing assets, NPAs.
How significant?
Gross NPAs jumped to 11.42% as of June 30th, 2025.
11.42%. Wow. Compared to what, a year ago?
Compared to just 2.78% a year ago, a massive increase.
And net NPAs after provisions.
Those also rose sharply. Net NPAs are at 5.00% now, up from only 0.26% a year ago.
Okay, these are stark numbers, and the bank is attributing this primarily to the microbanking segment.
Yes, directly. They point to weakening asset quality and collection efficiency there. The reasons cited are, quote, higher leverage at borrower level and weakened discipline for center meetings continuing from COVID times.
Let's unpack that slightly. Higher leverage at borrower level, meaning borrowers have too much debt from multiple sources.
Exactly. Over-indebtedness makes it very hard for them to keep up with payments, especially if income streams are volatile.
And the weakened discipline for center meetings. Center meetings are core to the traditional JLG model, right? For collections and peer pressure.
Absolutely foundational. Regular group meetings where repayments often happen, information is shared, and that group dynamic helps enforce discipline. COVID seriously disrupted these meetings.
And the impact lingers, it seems.
It seems so. That disruption appears to have led to a more persistent breakdown in repayment discipline for some borrowers, which the bank is now grappling with.
So with NPAs shooting up, provisions must have increased substantially too.
They did. Total provisions rose quite a bit, to 1,372 crore in Q1 FY26 from 514 crore in Q1 FY25. Reflects that increased recognized risk.
And what's their provision coverage ratio, the PCR?
The PCR stands at 59.2%.
Okay, nearly 60%. Now, are they just provisioning or are they actively trying to mitigate this?
They state they are strengthening collection efforts, putting dedicated teams and supervisors on the ground, really focusing on recovery.
Any indication if that's working?
Well, it's interesting, despite the high headline NPAs, they report that their X-bucket collection efficiency for Q1 FY26 was 98.7%.
What exactly is X-bucket efficiency?
It generally refers to collections from accounts that are already significantly overdue or potentially written off, so collecting on the toughest parts of the portfolio.
So 98.7% efficiency there suggests their focused collection efforts on the ground might be yielding some results, even if the overall NPA situation is challenging due to new slippages.
That could be one interpretation, yes. It shows active management at least.
Okay, so let's connect all this back to profitability and efficiency. We know the bottom line was a loss. How did the other metrics look?
Well, as you'd expect with the provisioning and the pressure on interest income, the key metrics took a hit. Total interest earned actually decreased by 9% year over year.
Interest earned went down, despite loan book growth, albeit modest.
Yes, likely due to the drag from NPAs not earning interest and perhaps the shift in portfolio mix impacting overall yield initially. Consequently, net interest income, NII, saw a big drop down 30% YoY to 402 crore more.
30% drop in NII.
Ouch.
Yeah.
And as we mentioned, the operating profit fell 71% YoY, leading to that net loss of 239 crore.
And the key ratio is reflecting this. Return on assets, return on equity.
Both turned negative this quarter. Return on average assets, ROAA, is negative 3.4%. A year ago was positive 2.3%.
Big swing. And ROAE.
Return on average equity, ROAE, is also deeply negative at negative 33.8%, compared to a positive 18.1% in Q1 FY25.
And operational efficiency, the cost-to-income ratio.
That worsened significantly, too. It jumped to 83.0% in Q1 FY26, from 54.1% in Q1 FY25. So costs are forming a much larger proportion of income, indicating reduced efficiency, likely driven by lower income and maybe higher collection costs.
So higher costs relative to falling income. That makes sense. What about the underlying yields and costs?
Yield on advances stood at 15.6% for the quarter. Cost of funds was 8.1%.
Giving a net interest margin, NIM.
About 7.5% for Q1 FY26.
Okay, NIM still looks relatively high, common for SFBs, but clearly squeezed compared to before. Now, despite all these profitability challenges, how's their capitalization holding up? That's crucial.
That's the silver lining, perhaps. The bank maintains a comfortable capital to risk-weighted assets ratio, CRAR. It was 19.64% as of June 30th.
Well above the regulatory minimum.
Oh, yes. And their Tier 1 capital ratio was also strong at 16.71%. So they have a solid capital buffer to absorb these kinds of shocks and navigate the credit risk challenges.
That's definitely a key strength. Provide some breathing room. Okay, let's look beyond the immediate numbers. Strategy, technology, governance. What's the longer-term game plan here?
Well, the strategic drivers seem clear. First, keep consistently increasing that share of secured loans. That's priority number one.
De-risk, de-risk, de-risk.
Pretty much. Second, leverage their existing customer base, especially in those unserved and underserved segments, but likely with more secured products. Third, expand product offerings generally.
And geographically.
Yes. Fourth is entering new geographies specifically for deposit growth. They mentioned targeting the top 100 cities, tapping into those urban metro deposit pools we discussed.
Okay, and technology. SFBs often talk a big game about digital transformation.
Utkarsh seems heavily invested here. They call it a 360-degree transformation. They're citing things like process automation using RPA, aiming for a 5x improvement.
RPA is robotic process automation.
Correct. Also, continuous digitization of servicing and collections, aiming for 100% automation for onboarding. They're using machine learning for smart scrubbing, even exploring generative AI.
Sounds ambitious. Core banking system changes, too.
Yes, they're implementing Finacle, a widely used core banking system. So it looks like a serious overhaul of their tech infrastructure, aimed at efficiency and better customer experience via WhatsApp, internet, mobile banking, etc.
It sounds like they recognize technology is key to navigating these shifts efficiently. What about the softer side, ESG and CSR?
They remain committed there, integrating environmental and social sensitivities. Their CSR arm, the Utkarsh Welfare Foundation, is quite active.
What kind of initiatives?
Things like skill and enterprise development, they say, impacting over 1.4 million lives, plus health initiatives, financial awareness programs, village development, and education. It seems core to their identity.
Good to see. And have they received any recognition recently?
Awards?
Yes, they listed several, including things like Credit Modeling and Risk Team of the Year, Best Technology Talent, Cybersecurity Team of the Year, and being named one of the most trusted BFSI brands.
BFSI being banking, financial services, and insurance. Correct. And finally, on leadership and governance, the board which approved these results is described as diversified and experienced.
Any notable recent appointments?
Yes. A Dr. Saurabh Ghosh has just been appointed as the head of consumer banking, effective August 2nd. He brings over 25 years of experience in banking, sales, strategy, product management. Seems like a significant hire for their retail push.
Okay, so bringing it all together, what are the key takeaways for you, our listener, from this deep dive?
Well, it really reveals a bank in the midst of a major and clearly quite painful strategic pivot.
Right. They're facing a really challenging quarter, a net loss, those sharply rising NPAs, especially from their legacy microbanking book.
But on the other hand, they are actively, deliberately de-risking that loan portfolio by pushing hard into secured lending.
And showing really remarkable growth on the retail deposit side, which strengthens their funding base significantly.
Plus, that commitment to technology transformation and their underlying social mission seems intact. The strong capital position is also a major positive.
So, looking at Utkarsh Bank's Q1 FY26 results, you see this clear tension, don't you? The strategic shift towards secured loans clashing with the asset quality hangover from the traditional microbanking segment.
Exactly. And this really raises a crucial question, something for you to think about. In this whole evolving landscape of small finance banks, what is the optimal balance?
The balance between serving those traditionally underserved segments, which is their mandate, and maintaining robust financial health, strong asset quality.
Precisely. How will Utkarsh, and indeed other SFBs facing similar pressures, navigate this dynamic tension in the coming quarters? That's the key thing to watch.